Like to get started. First, thank you everyone so much for joining. I'm very excited about the guest we have today. I think everyone that has joined is in for some really good information. Our guest today is Catherine Roy. She's a managing director and chief retirement strategist for JP Morgan. She has 27 years of experience in the industry and is focused on retirement income for more than 15 years. Catherine specializes in identifying themes, strategies, and solutions during the transition and distribution life stages, which I know many listeners today are interested in learning more about. Catherine's consistently ranked as a top speaker at major industry and firm-specific conferences. She's been interviewed and quoted in the financial press on a variety of key retirement planning topics. She received her undergraduate degree from Yale, and like myself, she's a certified financial planner. She's very good at putting it in simple terms in a way that everyone can understand. So thank you very much for joining today, Catherine. And with that, we can get started. And a question that I wanted to get started with that's kind of on my mind with all the changes that have happened the last year especially is what kind of trends you're seeing in the retirement planning space.
Well, I think there's a lot. And so Eric, it's great to be with you and with your clients today. I think there's a lot to take away from 2020, but I wanted to start, I guess, first with maybe a bigger picture question that I think 2020 has spurred in a lot of us. I think, our work-life balance changed. It was a year of disruption, tremendously tumultuous year, I would say. And so I think it gave us some time to reflect on, maybe how we want to be spending our time going forward, whether we're continuing to work in that pre-retiree stage or we're thinking about transitioning and living in retirement. I think that the learnings from 2020 combined with some bigger trends that we've been seeing over the last, I would say, decade, is that the transition into retirement isn't necessarily always a smooth one. It can be smooth financially, and you may be very well prepared financially, but you may be misunderstanding or haven't done your homework, I should say, enough on how you're going to go from being time poor to time rich. So really, to give you this sense, I thought I'd share some of our Guide to Retirement slides. So if you'll bear with me a second, I'm going to share my screen and shift into a slide I think visually brings it to life. I'm a visual learner, and I always like to see charts and pictures that bring kind of the concept home. And so one of the things that we're definitely seeing is this shift from being time poor to time rich is a major transition in anyone's life. And we often, as humans, we have this idea of what a future looks like, which we're the only animal that knows that or can think about that, dream about that. And we often misinterpret or we often misconstrue how the future we're envisioning is actually going to make us feel. And so to maybe put this in perspective, I'd just like to focus on the top chart here in our Guide to Retirement. It's a summary of the American Time Use Survey. About 20,000 Americans right now are recording how they're spending this exact minute. And we can use that data to show the trends in time use at each age cohort. So think of this as groups of people at these various ages, not one person through time, but it's giving you that big picture sense of how time is being spent. And the major takeaway I hope you are seeing is the shift from work in that really purposely ugly green to the very beautiful purple, socializing, leisure, and exercise. And usually I do these sessions in person. I always like to ask, how many of you find that exhilarating and exciting? And in my experience over the last 2 to 3 years that we've been asking that questions of thousands of people, about a third of you would probably raise your hand and say, oh my gosh, that's going to be so awesome. I have so much in the purple to do today. If I could just have less time in the green, I'd be so much happier. But that means that 2/3 of us really find this a difficult picture to see. And my reaction when my team built it for the first time was that I need to find some friends and I need to find some hobbies, because so much of my life is wrapped up in the green, my social community, where I find purpose. All those elements are really wrapped up in work, and I don't have enough outside of that in terms of those items to really make a rich life 7 days a week. So if you're thinking about every day being Saturday, that can feel overwhelming. And so we are seeing, again, these new trends emerging. You might have heard the term the unretired. It sounds kind of like the undead, or the failed retirees is another term. It really is encapsulated by a recent article in Barron's I thought was great. It was a couple of weeks ago. And the pullout quote, you know how they do that in magazines, they kind of get the main quote pulled out, was from a gentleman who said, if I was standing over a 5-foot putt and I realized I didn't want to do this for the rest of my life. And so that's a prime example, right? He was financially able to, had retired, and his vision of maybe playing golf every day was not turning out the way that he had anticipated. And he actually had gone back to work in some capacity, not full time, but he really needed kind of that activity to make his days really meaningful to him. And so what I'd encourage you to do is to really do your homework and think about, what am I retiring to, not just what I'm retiring from. Get on the same page with a spouse or partner. Less than 50% of American partnerships agree on retirement timing and that transition and how they're going to spend their time. So it could be quite stressful for a couple to navigate through as well. And if you are like me and have that, I need to find some activities. Yeah, the last piece of advice I'd give you is to practice the things that you think are going to make you happy. So one of the things I encourage you to think about, I'm going to exaggerate here a little bit, try 40 different things so that you can quit 35 of them and really whittle it down thoughtfully to 3 to 5 activities that you really want to dedicate more of your time to. That's going to be the best way to really make sure that you're transitioning and going towards a life that you're really going to enjoy. So 2 last things here. I just wanted to maybe bring this home a little bit for those of you who might be skeptical and thinking, Catherine, this isn't that big of a deal. Research shows that retirement is the 10th most stressful event we go through in our lives. And again, you're probably thinking, Catherine, it's not top 3, it's not top 5. It's 10th, but when we look at 1 through 9, it's pretty, I think, telling. So when you look at what's 1 through 9, 5 are marriage related. The most stressful thing we go through in our lives is death of a spouse. That's number 1. The other marriage related ones in the top 9, getting married, getting divorced, separating, or reuniting with a separated spouse. So that's 5 of the top 9. The next 4 are being fired, being incarcerated, or having a major illness for you or a loved one, and retirement is next. So I think that really does put it in perspective in terms of what a significant transition this really can be, and why it's important to do your homework. And then the last piece here is financial. We find this of concern just because we want to make sure you're enjoying your retirement and you use this time as to its maximum value to you. But we see a lot of households enter retirement, and when we look at their spending, it's quite volatile. It really does look like they're trying to figure out how to use this time, because essentially how you use your time is often how you use your money. And so the more prepared you are both to understand what's going to make you happy, the better prepared you can also be financially with liquidity, making sure that you have the right cash in the right place and are not having to harvest maybe at the wrong time, but that you have that confidence financially to be able to do those activities over time. So I think that's the major one I would start with, Eric, as a starting point.
Well, those were some great points. That every day is Saturday, you're right, does seem like a really good idea in theory, but I can understand when we're talking about people living longer and every day being Saturday for 30, 40, 50 years.
Exactly.
You really have to have this figured out. So excellent point. You mentioned the pandemic, and I'm going to go a little bit away from the changes in lifestyle that you were discussing, but with the pandemic, I've had a lot of conversations with clients about with the deficit, raising taxes, and especially for retirees. Just curious about what you think of taxes from a retirement planning perspective.
Yeah, so I know there's been lots of discussion recently about capital gains taxation and changes there, or raising the limit against which Social Security tax is applied. But what I wanted to focus on today is really the importance of being income tax diversified in retirement, and why, just because of where we are today, there might be opportunities to be better diversified and better positioned no matter where you are in your retirement journey. And so the reality is, taxes have been a hot topic for more than a year now, going into the election. Lots of proposals and ideas thrown around, but really without, again, going to another slide here, without any further change or legislation that's passed, we are already in an escalating tax environment because the Tax Cuts and Jobs Act, which was passed at the end of 2017, it is automatically set to sunset or revert in 2026. And so the estimate is about 95% of Americans are paying less tax as a result of that, that legislation. And so that would mean in 2026, 95% of us are going to be paying more tax. So that's what I mean by an escalating tax environment. So think about it as this little, as you look at that, those teal bars, this kind of little dip down that we're in today. We're still in a relatively low period for those marginal rates, but we all know it's not just about marginal brackets, it's also about the rest of the tax code that really is going to impact the taxes that we pay. So the best way to really protect yourself against future taxes from a retirement account perspective is to be very well diversified. And what I mean by that is having a healthy mix of both tax deferred or like a traditional IRA, where you pay taxes when you take the withdrawal, and also looking at your tax-free bucket, which would be a Roth 401k or IRA as that example, where you've prepaid the tax on the way in with your contribution, but dollars come out tax-free when you're making a withdrawal in retirement. There are also health savings accounts, which are great tax preferenced accounts if that's available to you. I'm not going to address that right now. I just want to talk a little bit about the diversification across these two account types, because I get a lot of questions about, well, Catherine, should I be doing a Roth now? Should I be doing pre-tax or traditional? You know, where are there some exceptions? And I think this chart does a good job of showing that. So this is really looking at a person's personal earnings experience in the United States, typically a typical experience. And we have to think about, you know, whether you do a Roth or a pre-tax, it's all about what are you paying today when you make the contribution or the conversion versus what might you be paying in tax in the future. And that's dependent upon your personal situation and the US tax code. So we already know that the US tax code is going to move up in 2026. So this is trying to answer the question about what about your personal situation? So in our 20s, on the far left side of the chart where that R circle is, we start out pretty cheap. I know I did. I came out of college. I was a Russian and Eastern European studies major trying to get into finance, which was crazy. And I was a really cheap employee, but I gained experience and my salary and my earnings obviously took me into higher brackets. When I was young, if the Roth had been available, and if you have children or grandchildren who are in that point in their lives, really saving in a 401k Roth option or using Roth IRAs, really a powerful dollar saved for a long-term goal like retirement. Obviously, as our income grows, right, we want to start hedging against our current taxes, throwing some of that taxation in the future because we might be in a lower bracket. And then when we reach our highest bracket, which depressingly for those of us in our 40s or early 50s, we're likely at that point, we want to be throwing all that money into the future so that we pay less tax when we make that withdrawal. So that's the rule of thumb. But the two exceptions I really wanted to highlight to those on the call with that background is we do see many mid-career managers, employees, successful individuals who've really taken their retirement savings to heart and have maxed out their pre-tax 401k and have done, you know, traditional IRA contributions in terms of non-deductible options that might be available. And they are concentrated in tax deferred accounts. So when you look at your retirement oriented wealth, I would say if you're 60 to 80%, your retirement wealth is that deferred type of an account. If you continue to contribute and maximize, you're concentrating yourself and putting you at risk for what future taxes might look like, right? Because every dollar you draw out is going to be subject to tax. And I would add, every dollar you draw out is not just subject to tax, but in retirement, it drives how much of our Social Security is subject to tax. And for many of you, how much more you're going to pay for Medicare because of the surcharges that apply to higher income retirees. So we want to be thinking about how, how do I have some flexibility? I don't want every dollar to drive all three of those things. So if you're that mid-career high earner who is concentrated on a tax deferred basis, thinking about at least contributing maybe to a Roth 401k that has no income limits, if that's available through your employer, is a great way to build a tax-free pool now to build that diversification. And then for many of you, you might be in circle number 2. So what circle number 2 shows is that often those individuals who retired and maybe are waiting to claim Social Security until age 70, you might have a very low tax situation for a number of years. And that's a great opportunity, particularly with the Tax Cuts and Jobs Act being in place, to maybe take some of that future taxation off the table, so you aren't like this visual where when your RMDs hit, you're shoved into, or you result in the result of those RMDs are being in a higher tax bracket, so you pay more tax on those withdrawals. So circle number 2 is really good in terms of proactive Roth conversions, taking some of that future tax off the table. And it really has multiple benefits. You prepay the tax at maybe a lower rate now. You get it into a tax-free account that grows for your life and is not subject to those required minimum distributions. And then lastly, it passes to beneficiaries tax-free as well. And now that at least human beneficiaries, the next generation that receive IRAs, have to withdraw those assets within 10 years, passing that tax-free asset can be really valuable, particularly if they're going to be in their high earning mid-career years as well. So it's a great strategy to be considering, talking to your advisor and your CPA about, in terms of the opportunity that exists today.
I think those are excellent points, especially the fact that doing it sooner, doing it now, just means more years of growth. Once,
Right.
like ripping the Band-Aid off, I guess, with taxes to some degree, where you pay it and it's not fun, but the idea of having that money tax-free for future years or for the next generation is, I know, really appealing.
Yeah, and I think you're getting one. There's an author that put a really great kind of visual, at least in my head, in my tax deferred IRA or 401k. You have to think about it as you have a shareholder in there with you, and that shareholder is the U.S. government and the taxes that are ultimately going to be collected. And so there's some freeing of, look, I want to get a little bit less of that shareholder ownership of my retirement by controlling when I'm paying the tax, when it makes potentially positive sense for me, and reducing that risk of what might be happening with the U.S. tax code going forward, really regardless of where you think taxes might be headed.
Great point. You had discussed earlier a little bit about spending in retirement. Just wanted to revisit that, specifically how we should be thinking about healthcare costs, because I know that's a key concern for Americans that are close to or in retirement.
Yeah, I think every survey I've seen in the last 10 years plus has been really across all affluence levels, concern about healthcare costs, the risks that those are going to be quite high, what the trends might be there. And so that's a really important category to get right. But I also want people to be thinking about their overall spending. So when we're talking about this transition and the emotional element of it, getting a good handle on your spending, but also understanding how it's likely to change over the course of your retirement. You're not going to be the same person when you begin your retirement that you are in the middle and you are at the end. And spending can adapt. So I think one of the interesting things in the COVID experience is actually this next slide, which I actually build. I'm a novice PowerPoint person, but this is one of the charts my team designates to me. And I was really shocked when I had to rescale it with how much we saved as a nation last year of the income that we earned and the federal transfers that we experienced, which I'll come back to that. We hit the 15% mark for the first time ever, as long as we've been tracking these savings rates back to 1960. And that's as a nation, right? We know that that's skewed in a lot of different ways. Usually higher wealth, higher income people save a whole lot more. We have a savings issue in the United States at the lower end as well. But what got us that incremental savings were three things: fiscal stimulus that happened in 2020, the unemployment outlays that the federal government supported the states with. Those are two biggies. That's about 2/3 of the difference. But a third was American households spending less by about $500 billion. And we always think about the US consumer being robust and household spending being pretty consistent. And so this was the first time we saw a pretty significant contraction in spending. Now, obviously, it wasn't for good reason. We don't want people not to go to the doctor or be fearful of going out, having lockdowns, right? Those are not positive reasons. But we do think that there's some opportunity from some of the things maybe you didn't miss to maybe memorialize in your head and think about, what? Markets get volatile again. Maybe that's something we won't do until things smooth out, and thinking about that proactively. Because we saw actually in 2020 Steady earners, so workers who didn't have an income disruption, reduced spending by about 2 to 5%. Retirees, again, not surprising, fear of the illness, threat of the illness, contracted by 5 to 8% over the course of the full year when you compare it to 2019 spending behaviors. So that gives you a sense of just kind of how much spending contracted on a household level and by whom. And again, the more wealth and income people had, the more they tended to contract, because more of their spending tends to be discretionary. So with that, I think it's important to understand that we can adapt when things kind of get challenging, but also we're not going to buy the same basket of goods for the rest of our lives. I know inflation is a big concern right now. I'm not an investment person. I think about inflation in terms of long-term impact on spending, which is a huge input that goes into your retirement plan. But what this is showing is essentially that older households buy differently, a different basket of goods than younger households, and they buy less of it. And we've proven this across wealth levels. We've proven this across generations. Really older households buy a lot more healthcare, which, to your point or your question, that's why we got to get healthcare right. We also, if you look at the bottom part of this chart, the light lilac, charitable contributions, political contributions, gifts to others, those are things that make us happier the more we do them. The good news is that older households do more of that as well. So you buy more healthcare, you do more giving, and really every other category you spend less on at those older ages. I would highlight one other category here is housing ex mortgage. So that's the dark blue. You'll see that that's the biggest outlay. A lot of people, if they're lucky enough to have paid off their mortgage, often think that their housing costs will really come down. And the reality is that the mortgage is part of your outlay, but maintaining that home, utilities, aging in place, those types of costs really remain consistent throughout retirement. So planning for those costs as well is important. But diving a little bit deeper into how spending actually changes, I touched on this a little bit. So this is showing the overall trajectory in a particular year. There's no inflation in here. It's just saying where did these older households spend, similar to that time use chart. Where did they spend their time? Where did they spend their money in the same year? When we think about the trajectory through time, this has been something that's been anecdotally referred to, and we do see in our data as well, as something for you to be thinking about as you're building your financial plan for retirement. And that is that there are phases of retirement. And this is coined by a gentleman by the name of Michael Stein, who is a longtime financial planning practitioner out in Colorado. And he did spreadsheets for his clients way back when. We're building all these cash flow plans. And he said, really, once they retired, they threw that all out the window, because they really spent this way the first 10 to 15 years or so. And again, we put ages on here, but whenever you retire, think about this first phase as a go-go phase. You have newfound time, that time-rich time. You have a bucket list, hopefully, and you have health, which health will not last forever. And so making sure you're aligning your resources to make the most of those early years is really going to be important. Then he saw those households slow down a little bit. They may have done all those trips. Traveling may be a little bit more difficult or not as enjoyable. They may want to spend more time with family. Maybe one spouse starts to have some health issues. So really there you go into the slow go phase. And he saw about a 20 to 30% reduction in spending on a real term basis. And then the last purple area, unfortunately the label's missing, but it should say no-go, the no-go phase, because you're really not going anywhere, but the big risk is with healthcare and long-term care. Now, we do know that, this kind of makes it look like healthcare and long-term care can go through the roof. I think long-term care is an example that could. Regular healthcare, generally we see the more you spend on regular healthcare, you're not spending in other categories. So it's not necessarily that your spending is going to go up wildly. It's really going to be substituted from other areas of your spending behavior. So with this backdrop, I think we're, again, with this transition into retirement, we're seeing some clients who've been really great savers, have built wealth really successfully. It is a very different mind shift to think about, I want to now use my wealth to enjoy my retirement. So we term those people the good savers, bad spenders, not bad spenders because they're overspending, bad spenders because they have a really hard time having the confidence to spend some of that wealth they've accumulated to enjoy their retirement. So I always like to talk to clients about this and say, give yourself your permission early in retirement to enjoy those years, because you will not spend as much later as long as you've captured healthcare and long-term care correctly. So to go a little bit deeper and on just two last slides, to put this in perspective on healthcare in particular, the reason why healthcare is so much of a concern across the wealth levels, it's a rare category that we buy more of, as I showed you in that rainbow chart, and it is the fastest inflating category currently when we look back historically. And so to bring that to life, this top chart is showing a comparison of, in gray, people 55 to 64 years old. So think your pre-retirees, what percent of their spending is going into these categories. And then the purple is showing someone in the midpoint or so of retirement, or beginning that mid-career phase, a mid-retirement phase in purple. And so you see over on the left, healthcare, right? There's 5% more of spending that's going towards healthcare for that older household than that younger household. The only other category that's really that significant is, again, that housing excluding mortgage, and on the far right, as we've mentioned, charitable contributions and gifts. But the one thing that's unique about healthcare is when you look down below. So when you look at just how fast healthcare costs are growing year over year. So the number of times you go to the doctor, the prescription drugs you're on, if you just stay steady state, that is generally going to go up by almost 5% next year. And then you have to factor in, I'm buying more of it because I use more healthcare as I get older. And that's why the growth rate needs to be a lot higher to not just factor in inflation, but this behavior as well. So what costs can you expect? I'll end here. I know I'm going a lot on about healthcare, but the costs you can expect once you go on Medicare, for example, here is original Medicare, which I think now is still about half or more of Americans, typically more affluent Americans that want to have flexibility in the doctors they go to, typically still choose original Medicare as opposed to Medicare Advantage. So that's why I'm showing you original Medicare costs. So original Medicare costs, we would estimate based on all the data we look at this year, if you're a 65-year-old new Medicare enrollee, it's about $400 per month per person. So if you're part of a married couple, that would be doubled. And again, we see a forward-looking growth rate of about 5.6. There are a lot of uncertainties with Medicare around solvency, means testing. So that's why we encourage a 6% growth rate for many of you on the phone. And so that really means that by 95, in today's dollars, these costs are going to be about triple what they start out at about $1,500 per month. Per person. So really important to get healthcare right. Obviously, long-term care would be a next topic maybe to talk about, but it's really important to make sure you have a plan and are factoring in Medicare costs, have evaluated and looked at long-term care as well. And then think about the rest of your lifestyle. Again, back to that go, slow, go, no go. How do we plan out these phases so that we can align resources and also give you the confidence to enjoy your retirement?
Those were some excellent points. And I think it's okay you spent the time you did on healthcare, because that's a major concern that we get asked a lot, and I know is important to everyone. Especially the last point with the long-term care. I think that last slide kind of shows why long-term care insurance, it is expensive, but for those,
definitely something to evaluate and consider.
For those that have used it or know loved ones that used it, they see the value for sure.
Yes.
Definitely something to evaluate. Along with a host of other things. So with that being said, thank you very much, Catherine. I just wanted to open it up for a few minutes for questions. During the chat, a couple came up, so I wanted to be sure and get to those. The first question is on spending. Is the 4% rule of thumb still relevant or reasonable?
Oh, okay.
I know, a complicated question.
Yeah,
I'm asking you for a simple answer.
Yeah, the 4% rule is a rule that I love for its simplicity, but I also hate it because it is simplistic and it's also fixed. So for those of you on the call that may not know the 4% rule, it was a question that was asked back in 1994 by a gentleman by the name of Bill Bengen. And he said, look, I just want to be able to tell my clients with the wealth that they've accumulated, what is the initial withdrawal rate on their wealth that they can take out, grow that amount by inflation so that they have constant purchasing power, and so that they don't run out after 30 years, right, they have a very, very high confidence level that they're going to have at least $1 after 30 years.
So if you started with $1 million, 40,000 a year.
Exactly. But it's not, a lot of people hear 4%, they think it's 4% every year of your portfolio. It's 4% of that initial value. And then you basically ensure that purchasing power for 30 years, which with my spending research, I just showed you that you don't buy the same basket of goods. Things are going to be different, right? So some of my frustration with the 4% rule is it is forcing people to pull back likely spending early in retirement for fear of running out of money. And what we see is actually the opposite in behaviors. People spend a little bit more early and they spend less later. And to bring that to light, I think the 4% rule with our long-term capital market assumptions, which are probably the most challenging they have been since I've been at JP Morgan for 10 years, the 4% rule still works with a 40, 60, 50, 50 type portfolio. So 40% equity, 60% bonds. I mean, you have to invest. You can't be all in cash and reach the 4% rule. You need to have investment exposure. And so with a 40% equity, 60% bond portfolio, at an 80% confidence level, which is pretty conservative, the 4% rule works. It doesn't run out of money, but it barely, makes it to 30. So I think, 4% rule still works. To bring home the problem with the 4% rule, when we look historically at 60, I think it's 63 rolling 30-year periods that we can look at. What if in each of those 30-year rolling periods, you actually had implemented the 4% rule with the inflation environment that existed at that time, with the actual returns that those portfolios would have achieved? You have a 1 in 5 chance that you would end with 5 times the amount you started with. You have a 1 in 4 chance you're going to end with 4 times the amount you started with. And, on the flip side, only about 16% of the time would you have run out of money. So it is, I just want to position that as, it is a rule that is trying to protect you from running out of money, and that is its main goal. It's not a rule that's trying to help you use your capital in an efficient way to supplement your other sources of income and to enjoy your retirement based upon, again, how we see people actually behave.
Thank you. Next question. Aside from the generic, you did not save enough, what would you say is the most common error people make when preparing for retirement? There's a few things you discussed. What came to my mind was asset allocation or tax diversification, or maybe it's a separate issue that you think is a big error that people may make going into retirement.
A risk we definitely see attitudinally that I think is a big one is people thinking they're going to work longer than they actually do. So I think about 76% of current workers say, yeah, I'm going to work to 65 or beyond. And for a number of different reasons. They'll say, look, I like the social connection. I have purpose. I had an 80-year-old professor in Chicago say, I finally know what I'm teaching, right? So, you have positive reasons why people say that. The reality though, and it's not just for the money. I mean, obviously there are households that say, look, I need to, in order to, make ends meet, or to buy extras, or health insurance is a big part of that. The reality is that I think about 25% of people actually do work past age 65. And the major reasons why people leave the workforce early is disability, health issues that were unexpected that take them out of the workforce early, changes at the company that they were working at, they didn't anticipate. Some of it's caregiving, particularly for women. And so I just think, protecting human capital, which is what you're earning in those last 15 years or however long that time period is really important. To save as much as you can, right? To not start tapping the portfolio early. Disability insurance for that period of time, I think, is really important for higher earners. So I think it's that kind of myth that I can just keep working. If the finances, if I'm short, I'll just work a little longer in order to make it up. That can be a strategy, but it can't be the plan, because you don't have complete control over your ability to do so. There are a lot of things that come along that make that not possible. So having a backup plan is going to be important.
That's great. And what we see a lot is when people go into retirement, you don't always think that it's going to be 30 or 40 years. So getting too conservative too early, or too early, we see the extremes on that side, I guess.
I would agree. You may get asked, I get asked by a lot of people that are 5 years away from retirement, how should I be thinking about investing for the next 5 years. And because they're thinking about retirement kind of as the beginning of retirement as their endpoint. And
Right.
I, like you, have to say, look, take a step back. You have 30 years beyond that is really your time horizon. And so you're going to want to have a balance of both, you know, meeting near-term needs, but also growth for such a long period of time.
Yeah. Okay, I think we have time for one more question. Any thoughts on the best time to make a major move in retirement, either from the cost or energy level perspective?
Make it move like a housing move, a location?
I think that the question means like timing retirement. Like, should you go just when you're out of energy or just cost? I think that's what it's asking, which I realize is going to vary greatly from person.
Yeah, I mean, I think there's a phrase that you retire when you have enough.
Uh-oh, Catherine, are you still there?
When you've had enough. Let's see. There we go.
You're coming
my
back.
Internet. Okay, my internet's.
You just left us in suspense.
All right, Eric, am I back? Can you see me or
Yeah.
hear me? Okay,
I
so
can
let me
hear
turn
you.
off my video.
I can hear you. We're left in suspense.
Okay, good. Let's do. So there's a phrase, I don't know where I cut out, I apologize, but there's a phrase that you leave work when you have enough and you've had enough. So I think that's part of it. I do think there's an element of retiring early enough while you have that health to do the things that you want to do, that you need to balance in. But I wouldn't underestimate this idea, this transition period, because we actually see a lot of households start to practice retirement and how they're going to spend their time so they can be clear on what they're retiring to. And you're going to want to do that once of, you know, leaving the workforce and retiring as an overall household in total. So the only other kind of age that's important is we get a lot of questions about when should I move into an assisted living kind of or active community in order to really benefit for the full continuum of care. And we know that's usually in your mid to late 70s is kind of that sweet spot, because you want to be able to get in, you want to enjoy what those independent side of those communities offer before, you know, there may be some progression of care needs. So that would be the only other kind of age I would highlight.
Excellent. Looks like there was one more and we have 1 more minute. So if, I don't want to lose you, but I want to get to as many questions as I can.
Sure, yeah.
I think this is an excellent question. What are some things to think about when a couple has very different retirement time horizons? What should they be asking themselves or planning for? For example, one partner is retiring 10 or more years before the other.
Oh, you know, this is a really difficult question. I usually start by saying I can't give marital advice, and this kind of goes down that path. I think, you know, I'd actually position the answer maybe the opposite direction, because I think when many couples retire at the same time, that's equally stressful because they think they're going to spend all their time together and they have to do all of their activities together. So there's definitely advice I would give that type of couple to say, look, you want for better or for worse, but not for lunch. You want to have separate, separate interests that you're pursuing, separate groups that you're with, because you want to come together for dinner and have stuff to talk about or things that you experience that are different than your spouse. And so that's really an area that we've seen a lot of growth in. The other advice is don't live within 30 miles of your children and grandchildren, because happiness in retirement is generally beyond, you know, that, so that you're not taking advantage of. But for this particular question, I do think that retiring at such different times means that emotional transition is going to happen very differently for each spouse. And so, you know, they're going to get into a rhythm where one's working and one isn't, respecting those choices. I think continuing to discuss them and reevaluate whether that, if that's the original plan, if that continues to be the case. But I do think that takes a special level of discussion on the use of time use, because then that person who's been retired for 10 years is in their routine. When the person who's been working now enters that, they really need to be given time to figure out what their retirement's going to look like, and not necessarily just fold into that already retired spouse. So I think, I'm not sure I'm giving a good answer, but I think it is a difficult emotional journey that good communication, discussing it often, reevaluating it often, and being honest about what you want as an individual and how best that works with the couple is going to be particularly important for them.
No, I think that that's excellent. We're running up on time, so I'll end it here. And I just want to thank you again. It was great having your expertise for this call, shared a lot of valuable information. And thank you, all the participants that were able to join. This is being recorded, so if there's anyone that you think would find value from this, please feel free to share. If you would like to reach out direct for any questions, please feel free to reach out to me directly or anyone else at Argent Bridge, and we'd be happy to help. But with that, I will leave it and say thanks again, Catherine, and everyone for joining.
Thank you, Eric. It was a pleasure.